Hey, it's Mike. I'm not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we are talking about building a side stream of income using other people's money. I've been gone for a couple weeks now, so this is just an update of where I've been, things like that. And without further ado, let's get started. So one of the most important things on this channel that I've been talking about for some time is borrowing other people's money. And so throughout, investing in different type of investment vehicles like income funds and doing options myself, I have kind of transitioned back to where I'm doing the option investing myself, and I'm putting a little different spin on it. So this is before I started investing in the income funds, I was kind of already doing something like this, and I thought I could get a higher return investing in income funds. But then ultimately, after doing and actually investing in the income funds themselves, turns out they're not as good as they used to be. So we're still building a side stream of income using other people's money, but there's a little change in course. We're not turning the ship all the way around. We're just changing the course a little bit. So again, on this channel, what we like to do is we like to borrow money. We have really good high quality foundational holdings, and then we borrow money against those holdings. So my foundational holdings is Tesla. You can invest in the S&P 500. You can invest in triple Q. You can invest in SHD. Doesn't matter what exactly you're investing in, but you have a really good base foundational layer of holdings, and those holdings will allow you to use other people's money to make money. So what I'm doing is I'm selling cash secured puts using margin collateral. So what does that mean? So essentially right now my account is about $250,000. I can use I can sell what you call naked cash secured puts, meaning I don't have the actual cash in my account to fund the collateral for it, but I can use margin collateral. And so in doing so, when you use this margin collateral, you're producing income without actually holding the underlying or the actual holding, which means you can generate income without accruing margin interest. So that's kind of a benefit of doing like a cash secured put strategy. However, this is a much more advanced strategy, and if you do this wrong, you can really put yourself in a really bad position. But if you're smart and you think about how you do it, there are ways to do it, and I'll explain kind of what I do. I'm not telling you exactly what to do. I'm just showing you what I'm doing. So this is not advice. This is just showing you my journey. So then on top of selling the cash secured puts, what the main plan is to also sell covered calls on the actual holdings you own. So ultimately, if you do a bunch of back testing, you get into the details. The truest way to build wealth is to own actual companies. If you own things in life, whether you own rental real estate, you own companies, that is what grows you wealth over time. And in doing so, what I want to try and do is I want to continue holding great companies, but then I want to optimize some income. So what I want to do is I want to get whatever gain that year for that company or fund is, I want 5% above that. So for example, I want to make about 5% in premium on my my covered calls that I'm selling on the actual holdings that I own. So for example, I own 900 shares. I'm trying to sell covered calls, which would net me about 5% in premium from my overall portfolio. So not only am I getting a lot of appreciation, I'm squeezing out a little bit more in income, but that income is going to allow me to outperform over the long run. And then moving along, so kind of this is what the plan looks like. So your base, your foundational holdings is what you'd own. So say that's the S&P 500. I own Tesla or 900 shares of that, and what we're doing is we're selling covered call, which obtaining a 5% return from the premium. So for example, 5% return on $100,000 is $5,000. You annualize that over 52 weeks. You really don't have to make that much in premium to outperform. So a lot of people are trying to hit these Hail Marys or moonshot gains option investing, and honestly, you really don't need that much to outperform. So, if your goal is just to outperform the S&P 500 and you just own the S&P 500 and you did this exact strategy where, if you had 100,000 S&P 500, you need to make $5,000 to make 5%, put that over 52 weeks. And if you're doing dailies over 5 days per that week, you only need to make like $20 a day or $30 or $40 a day, which is not really that much to outperform. So kind of like a interesting take. So, we're most of your gains in the stock market is going to be the actual share price appreciating. It's not going to be the income you make from option investing. So, there's some people out there who want to get the majority of their gain from the option investing. And, it is really nice to see all that premium hitting your account and things like that. But the truest way is when you're option trading, you're trading, and ultimately what you're trading are stocks. And ultimately when trading stocks, the most important thing is price. If you're making more money than you sell for, you're winning. However, to build wealth, you need to hold on to the thing, and then we're going to squeeze out that extra income. So that's that covered call portion. So, the middle is owning the foundational holdings. Then we're selling covered calls above it to, kind of harvest premium. But then also we're using money we don't have. We're using margin collateral at a very safe distance to make more income. So what that sounds like is, for example, if my portfolio is worth $250,000, I like to take 50% of that. So 50% of $250,000 comes out to $125,000, and I like to use that to sell cash secured puts. So if my account happened to drop 50%, then I have a decent buffer of margin to, if case the market goes down, that I would be fine. Because then if I did eventually get assigned, then when selling cash secured puts, your margin maintenance is a 1-for-1. Whereas once you actually get assigned the shares, it's like a 1-to-3 or 1-to-4. So that means, like, if you own the S&P 500, you borrowed $100,000, you're putting $100,000 in cash secured put option collateral or margin maintenance. But then once you get assigned, it gets down to 25% because it's a 25% maintenance requirement. So what I'm trying to do is, of that $125,000, I'm trying to make about 10% return. So 10% return on 50% of my equity comes out to about 5%, 5% for my covered calls. So my overall return that I'm trying to make is about 10%. And then these are the goals that I'm trying to get from doing this type of option play. So my goals: selling covered calls on an underlying, bringing in 5% return from premium plus stock appreciation, and that is to outperform the S&P 500. I could very well be doing this on the S&P 500. However, I have a high conviction in Tesla. From what I'm seeing, it is the future. The products that they make, the energy business, the AI, is second to none, and I believe that is the way of the future. However, if you were not so adamant about Tesla, you can do this on the S&P 500, get the 5% return on the premium, and you're still winning. And then, same thing, like every single time, if any of you that have followed me, I have invested in income funds. So when you invest in income funds, you're losing out because you're losing NAV erosion. Every single time a payment gets paid out, you're essentially getting that dividend paid back to you. So you're not really necessarily getting a gain until after you've made all your dividends back. And then on top of that, you're eroding your money. Your tax situation isn't as good as it says it was. Apparently these income funds are supposed to be like tax efficient. I mean, I paid a lot in taxes when it came to tax time. So like, are they really as efficient as they say? Like, how can it be efficient when, if you sell options yourself, you're taxed at your income bracket, but when you do these income funds that do the same thing, but someone else does it, it's different? Like, doesn't make any sense. And then continuing the strategies. So like, some of those cash secured puts, we're not being charged margin interest unless we're assigned. So, if the deltas that I pick to get the 10% return on that 50% equity, the deltas that I'm picking are almost like under 5 deltas. Like some of the deltas are even down to 2 to 1 delta. And if by whatever reason, if whatever holding like that Tesla S&P 500 goes that low, then I'm going to be buying in at such a good price that I should be able to turn that around and sell a covered call at the money and then continue the cycle. So kind of thought process. And then, should be able to sell at the money. And then again, going back to what I was saying, from between the 5% from the covered call and the 10% of 50% of the equity should come out to about 10% of yearly income. So, whatever my portfolio is, I should be harvesting about like 10% worth of income. So honestly, like, if your portfolio is $100,000 and you're making 10% in 10 years, you made $100,000. Your portfolio is $1 million, 10%, $100,000. And again, the whole point of this is to not fundamentally change the course of your portfolio. Like, you're still investing those foundational holdings that are building you the wealth, but you're just optimizing a little bit of income here and a little bit of income here. And that's kind of what my new strategy is going forward. So, I could invest in JEPI, I could invest in JEPQ and GPIX and things like that. But at the end of the day, they're doing the exact same thing that I would be doing. Like, they're just investing in either some of the underlyings in the S&P 500 or they're investing in the S&P 500 in general. So I'm paying an expense ratio for them to do the exact same thing that I would be doing. So I don't know. I feel like the fact that I have the control and I have the ability to roll those options, if I'm getting assigned or getting close to assigned, I kind of like being in that position. All right, so let's actually go to the portfolio. So that was a mouthful. So presentation's over, and this is the portfolio. Okay, so just kind of going down the list. My total portfolio value is $251,468. So right now it is Sunday, 9 p.m. Midwest time. So it looks like the stock market is somewhat open to some degree, and just like one day return, whatever last week return, we're actually up big time, $24,000, 10%. Last month, up 5.61%, which comes out to $13,000. The last 3 months, we are down 0.28%, which comes out to $711. Year to date, up 18 grand. And in the last year, we are up $90,000. So Tesla's doing pretty good this year. And just kind of running down the list here, these are all my different positions that I own. So I own 900 shares of Tesla, and then I'm selling 9 covered calls against those Tesla shares to generate income. So ultimately what I did is, I sold these, I was selling covered calls. I got a little greedy. I was selling closer to at the money, and then I got getting close to sign, then I rolled it. Then the stock or Tesla decided to go on a parabolic move up, went on a rocket ship and moved up to about $450. And I had to keep rolling all the way up so I don't get assigned, because I really don't want to ever get rid of these shares. So I kept rolling and rolling my positions up until eventually, like the share price of Tesla came down and kind of cooled off. But, I had to roll it out to such a point where now my covered calls that I'm selling are pushed out to January 15th of 2027. So now if we look at this, I'm actually up on this position because, total return, I'm up $53,000. So if you look, the total amount of money I got paid out is $101,000. But after rolling everything and whatnot, I'm up $15,000, which helped me get up to 900 shares of Tesla. I used to have 834 shares of Tesla, but the fact that I did these covered calls, I was able to get a couple extra $1,000 to bump it up to 900 shares of Tesla. So this is kind of thing like, still up on this position. Not really much I need to say here in terms of management. Can I roll this position? Let's just take a look. So anytime I'm trying to roll a position here, I'm always trying to roll for a credit. So there's a couple of things, like I'm either trying to roll for a credit or I'm trying to roll down for a credit. So there are so many ways you can go this. Like, I guess the thing is, like, what is the most important thing to you? Is it having it expire closer, or would you rather have a higher strike price? And that just really depends what you want. But let's just take a look what we're working with here. So this is in 781 days. So let's see if I can roll this position. So share price is $282. So I believe mine is the 450 call. So this position is 53. So this would be 5,360. So if I go up to $500, 5,600, 5,600. So just to slightly roll right above it, the winner would probably be 510 here. So like I'd be rolling up $60, but then I'd also be rolling 6 months out. So just for that fact alone, I really don't want to touch this position. I do know in the future, Tesla will probably be up much higher than $450. But as of right now, I mean, if push comes to shove and Tesla keeps moving, I will roll it out. But right now, I mean, I'm just kind of sitting pretty. I don't need to necessarily do anything. I'd rather do something closer to January of 2026, just so that in about a year's time, we can see where we're at. Because Tesla might not necessarily move in terms of the balance sheet this year. So the share price might not necessarily go up unless, the robo-taxis are printing money. Let's look at the Tesla position here. So overall, I believe I bought in for about $267. Total return, I'm up $13,000. And then we'll go to our history just to kind of like show you all the different trades that I was doing here. So, and then I'll illustrate more of a point when I get to my spreadsheets here. But in the last week, I made $216 plus $100, $316 just selling these cash secured puts. The week prior, what does that put us? $240. I sold a put on Tesla. I made $750. And then right now I'm good with buying options. I'm just going to stick to selling right now. I got lucky to make my $40,000 play, and I'm just going to be sitting pretty here. So doing pretty good here, and we'll illustrate all these different puts here when I go into my spreadsheet. But let's go to the one thing that does matter here is this account value. So overall, My stocks are worth about $206,000, and then I have about $45,000 of cash. So right now I'm not running any margin. So I'm totally liquidated of all my margin positions, all my XDTEs, my yield max funds, all of them are out. I have cash in this account. And so what I've been doing with this $45,000 is I've been a little bit more aggressive in selling my cash secured puts. So, I want to buy at least 100 more shares of Tesla just so I can have an even 1,000 shares and be happy with it. But I want to buy at the price I want. And in doing so, I'm selling cash secured puts to buy at the price I want, as well as make some premium. So what I've been doing is I've been selling puts, and I've been selling weekly for the next 5 days. This is where we're going to be at. So I'm looking at probably like a 10 delta. The ones that I use the margin collateral for, I'm much lower than a 5 delta, but I feel a 10 delta is exactly where I want to be. So this is $166 per contract. This is right under 10, and I think this is what I would probably do Monday morning. So I'd be buying at $247.50. I'd be getting $146 per contract, and times that by 2, because I could essentially own about 2 contracts of Tesla. And yeah, so we'll probably do this one. So we'll do 2 of those. And then, I'll be buying below my cost basis, and I'll be getting paid to do it. So that's what I'll do with the $45,000 of cash that I have sitting in my account. But because my account value is 250, why is it lagging here? 250. I would take 125, I would take half of that, and that would give me $125,000. And what I am going to be doing for Monday using the option collateral is I'll be selling those cash secured puts. So what I would be doing, I already did the math, so it's about 5 contracts worth for $125,000. And so what I'm looking is probably around a 5 delta. And actually, just to run the numbers here real quick. So if I want 125, 1, 2, 3 times by 0.10, I want 10% return off that 25%, divide that by 52 weeks, about $240 a week, divide that by 5 contracts. So I need about $48 a contract to hit that goal. So I can hit exactly $48, but when the market opens, this is going to be oscillating up and down. So I'll probably do something like right here. So that puts us at a delta about 2.9, almost a 3 delta. So 3 delta, buying in at 217, $50 per contracts, 5 times 5, $250. So making $250 per week, pretty solid. And over that course of that year, making $12,000, doing absolutely nothing is fantastic. Like, this is using other people's money, building that side stream of income. So this is exactly what we're doing on this channel. So like, we're investing in great holdings, we're building a side stream of income. We're building wealth, but then we're optimizing a little bit more income. Okay. So that's kind of what I'm gonna be doing this next tomorrow morning, Monday morning. So show you what we're doing with that, and then let's just go to the spreadsheet here. So this is a wheel strategy. So these are all the different wheel options that I've done. The higher count number is the more margin one. The two option contract ones are the ones that I just have the cash that I eventually do want to get assigned. But again, I'm just trying to buy it in at a really good price. If it never hits, it never hits, and we'll just keep getting that premium. But yeah, so this last week here, so if you look at the 21st, again, $316. This week, $240. This week, $458. This week, almost $600. And again, not getting a sign. So like, I'm selling at such low deltas over here that if I do get a sign, I should be able to sell a covered call right away. Like, I'd be buying at such a price that hopefully at that point, the market will rebound. And, so just a quick tidbit on option investing. So if your delta is a 5 delta, you have a 5% chance of getting assigned. So over 100 weeks, you're going to get assigned about 5 times. So, in a 2-year period, you're going to be getting like assigned 5 or 6 times. So if you do get assigned 5 or 6 times, then, you should be able to sell a covered call right after. And then you can see here, I made about $1,899 since, last week of March. Mid-March or whatever you want to call it. Yeah, so it's been about, almost a full month and a half, and I made about $1,900. That's pretty solid. And then again, here are the goals that we're trying to do. So we're using the margin. So this is strictly the margin. So the covered calls, not using margin, cash secured puts using margin. And, we're making 10% a year, about 10 to 5 delta on individual stocks. We're using 50% of equity as collateral. If assigned, we're selling at the money covered call or 1 up. Cash does not accrue margin interest. Again, I'm not paying any type of interest selling selling cash secured puts because they're naked. But then when I do get assigned, then I'm going to have to get pulled from the margin to get that. And then we're selling daily to weekly. So at some point I could switch to the S&P 500. I can switch to triple Q. Doesn't matter. But the goal is to make weekly income. And then again, every single time you get paid, you're not getting your net asset value eroded. It's not like, my $250,000 account goes down by $316 once I get all this premium. Like my account goes up by $316. Like that's how it works. Whereas if you invest in those covered call funds, you're accruing margin interest because you're investing in the funds. And then every single time you get paid out, your account goes down that much. So are you really pushing the needle forward? Just like the cash secured put strategy, and this is the long-term covered call strategy. So these are every single covered call that I sold in Tesla, and then in like October, November, I had to roll these positions out to a point where again I did have to roll out to January 15th, 2027, but I'm still up over $15,000. So the option premium paid out how much I bought it back for. So I'm up $15,000. So we're up 15 grand. If I do have to roll it out, then, I'll show you when I do roll it out. But if not, then, I'm pocketing this 15 grand and it's pretty good. But at some point I probably will have to, if Tesla's going on the trajectory it's going on. All right, well, that is it for the video. So, if y'all have any questions, definitely let me know. But this is kind of the new strategy going forward, and we'll see how it goes. And, again, I'm going to try to do my best to sharing the journey. But, life got busy the last 3 weeks. So just wanted to show this out, give you like an update, just show that things are going okay. Like I didn't, do any crazy thing that my account imploded or anything like that. So still here, still kicking, making smart money moves, and we're going forward. So hope you have a good one. Have a good one. Peace.